Yep, thanks a lot for that, Avan. And yes, interesting chat for sure with Nilesh Shah right here in BSC. He's here to ring the closing bell. But just before we do that, 15 minutes of trade left. Nilesh, thanks so much for joining in. It's an interesting occasion. We'll talk about that when we go and ring the gong. But we're in the thick of earnings season. You know, Maruti, Vedanta, both of them have just come out, and which is why I come to you a bit late. What have we made of earnings so far?
I think it's been reasonably good set of numbers. I think overall in the backdrop of expectations, I think the expectations were very muted. The expectations were hardly there. I think in that context, I think reasonably good start to the earnings season so far, especially some of the bellwether guys. But does that therefore saying, are these numbers good enough? Is this something which is going to satisfy the street? I don't think so. Given the kind of valuations which are there for a lot of these companies, it looks like that probably the companies will have to deliver a lot more in terms of the year-on-year growth or the quarter-on-quarter growth to be able to justify these valuations and also to create a room for a further upside in the short to medium term.
What did you like about the numbers? So let me just dissect them into two or three: banking, autos, and IT. Let's start off with IT, because the street was by and large disappointed with the numbers. Somehow I got the sense that the commentary from three of the four was extremely positive, and a lot of people differ with me on this, but you've tracked this very, very closely. What did you make of the commentary that came in by and large from the IT majors?
I think the technology pack perhaps has come out with the best set of numbers. Broadly, if you really look at it, there has been single-digit dollar revenue growth, there has been double-digit rupee revenue growth, margins have by and large been intact. In some of the cases there has been margin expansion. A lot of companies are still kind of positioning themselves to capitalize on the digital opportunity. A few of the companies like say Infosys, for example, are even thinking beyond digital and looking at things like automation, design thinking, artificial intelligence, all of that. So it looks like that by and large the sector is poised for some really good times. I think of course the currency depreciation helps them. I think they're thinking forward, they're thinking positive, and I think on the whole valuations are reasonable, expectations are kind of reasonable from the sector. So I think clearly as an investor, we would be very constructive on the sector from a 2 to 3 year horizon.
Okay, and the pecking order would be what, Infi, TCS, HCL Tech, that way? I mean, if you're at liberty to say.
Yeah, I think clearly Infosys stands out. Clearly I think they have the right leadership. The new leadership has the right thought process. They have new ideas. They seem very capable to execute. They seem to be understanding what the market opportunity is. And clearly as a stock, Infosys has underperformed for now many years. It has played second fiddle to TCS or HCL Technologies. So I think in that backdrop, it looks like that Infosys is really poised for some better times over the next 2 to 3 years.
By the way, keep in mind, these are not recommendations. These are just viewpoints given by Nilesh Shah. The other set of companies which have come out with numbers, Maruti today, the other two-wheeler majors that have come out, Hero MotoCorp, Bajaj Auto, not a disappointing set of numbers at all. And Tata Motors, I mean, is kind of still reeling under the Chinese pressure, but has recovered a little bit of lost ground as well. What are your thoughts here?
See, I think overall the entire auto pack, I think the big takeaway is margin expansion. I think a lot of them are having really good, nice, strong margin expansion. Two is the size is getting bigger and bigger for of them. They're not degrowing. You know, if you really look at the entire pack, be it the two-wheeler pack, the four-wheeler pack, as a basket, clearly there is growth. It could be low single-digit growth, but I think in this kind of an environment, even if you be able to grow at single digits, I think it's very, very good, and hold on to margins, expand margins, because this is going to hold you in good stead. I don't think the automobile sector in India is going to remain confined to a single-digit growth. It's clearly that when the economy does start growing at 8-9% plus, when the rural economy also picks up, and if in the next 6 to 9 months interest rates come down further significantly, maybe by another 50 to 100 basis points, I think on the whole, I think it's a fantastic situation for the entire automobile sector.
Okay, I have two more questions before I toss it back to the studio, and then we of course go and ring the gong as well. One is on what did you make of the mid-sized banks? You know, we are all talking about how large cap banks' performance is putting a lot of pressure on the PSU banks. They are taking away market share, so on and so forth. Somehow, a federal bank, a DCB gave a sense that maybe all is not that well with the small-sized private sector banks as well. They are feeling the heat too.
I think they are facing unprecedented challenges. The tier 2 small size, medium sized banks, I think they're facing unprecedented challenges, and I think they're going to have huge margin pressure over the next few years, because there is technology, there are new set of banks coming in. So I think a combination of all of these faces, it poses a lot of headwinds to them. So I clearly think that the tier 2 banks I think are going to face a lot of challenges going forward, and I think at this stage they're best and avoid.
Best and avoid. Okay. And lastly, again, I don't know if you can comment on this or not, but from amongst your portfolio holdings, if you're at a liberty to talk about what some of them have done until the earnings season so far, what you expect them to do. I don't know if you're at liberty to comment.
Yeah, I think I wouldn't want to get into specifics, but I think by and large, we're clearly overweight on consumer and technology. These are the two big pockets that we own. And I think across the board, both these...
Consumption numbers weren't the best. I mean, HUL or some of the others did.
Yeah, but we own the tier 2 kind of lot.
Okay.
So out there, I think we have individual companies in the consumer durable space or the fashion apparel space. I think all these companies are in the health and wellness space. I think these are companies which have done reasonably well as a pack. Of course, there are outliers. One or two of them have done exceptionally well, one or two have not done very well. But I think as a basket, I think we're reasonably satisfied given that expectations were not high. And we think that the best is yet to come for these companies. And I think these companies are making all the right investments, be it in their brands, products, distribution. I think, and therefore they're poised for some really better times.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.